Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking some time out of your busy day to spend it with us. We have a fantastic show for you today, a fantastic guest. I was able to catch up with the Finance Minister of Ontario this past week, the Honorable Peter Bethlenfalvy. We spoke about the economy in Ontario, what he sees, his opinions on interest rates, taxation, housing. We got into all of it. It was a fantastic interview, and we're going to show you that interview this afternoon. We also have our This Week segment. What should investors consider over the next couple of weeks between this show and our next show? What you should be considering before you make your investment decisions. We usually have three topics or three ideas. Fed adding to volatility. Interesting topic. Mohamed Al-Arian came out this past week or so in Cambridge, and he talked about how the Fed is creating a lot of the volatility that we're seeing in the stock market, speaking perhaps too much. A lot of the Fed governors coming out with their opinions, and opinions are mixed. Some are hawkish, some are dovish. A lot of what the Fed governors and Jerome Powell himself, the chair, are talking about are things that are in our rearview mirror, being more reactive versus proactive. So we'll touch a bit on that. U.S. debt annual interest payments. In the next, I believe it's the next 6 months or so, the annual interest payments on U.S. debt will climb above $1 trillion. Unbelievable, a staggering number. We have an amazing chart to show you, which will illustrate just how quickly this number has moved higher. Top three things that indicate a year-end market rally has started or will happen. And for those of you that watch the markets or follow the markets on a day-to-day or week-to-week basis, you might already say maybe the year-end rally has already begun. In the past week, or when the calendar turned to November, we saw the markets start to turn significantly higher. And whatever the concerns were from the past few months, for whatever reason, those concerns have seemed to go by the wayside, and the markets seem to once again climb that wall of worry. Lastly, I'll take some of your questions that you have during the show. Please put them in the comment box. I'd love to be able to get to them at the end of the show. If I don't, I'll try and answer them within the next couple of weeks before our next show, or perhaps look to address those questions on our next show. So without further ado, let's get on with the show. Welcome Ontario Finance Minister Peter Bethlenfalvy to the show. He became an MPP of Pickering Uxbridge in 2018, initially serving as president of the Treasury Board and later named Finance Minister on December 31st, 2020. Before he entered politics, Minister Bethlenfalvy served in senior leadership roles in financial institutions, including president and CEO of TD Securities USA, as well as co-president of DBRS, which is a credit rating agency. He also served on boards of several charitable organizations. I'd like to welcome to the show, Minister Bethlenfalvy. Thanks for being here.
Great to be with you, Allan.
Excellent. I thought we'd have a bit of an informal chat. I know you've been answering a lot of questions lately about the economy, but for our listeners and viewers, we've been talking a lot about Canadian economy, I guess, and this idea that we're sort of headed to perhaps a mild recession. And I think over the last couple of quarters, we're kind of skirting that flat line in terms of growth. And I guess if we do go into a mild recession here in Canada, what do you think, or what is the state of the economy in Ontario? Would we follow the rest of the country, or can we, continue to grow, even though the rest of the country may be pulling back in terms of growth?
That's a really good question. And of course, the classic answer is it depends. One thing I do know is that I don't know what's around the corner, but I do know that Ontario's economy is a $1 trillion plus economy, one of the fastest growing economies in the world, one of the fastest growing populations, the fastest growing population of a similar size state in North America, and that with our diversified economy, we're able to weather any sort of storm. It depends on what type of recession is. Is it financial? Is it economic? What are the headwinds that are causing that? As you know, we're in very uncertain geopolitical times, and there's economic risks right across the planet, be it from China, from Europe, from the U.S. And being a small open market economy here in Canada, we have to always be nimble. But I feel very good about Ontario. I feel very good about Canada. And of course, a lot of people want to come to Ontario. So we have a steady supply of labor. We just have to target the types of skills that we need. Building things is very important. Our healthcare system, our education system. So I don't know what's around the corner to answer your question. What's around the corner economically? Just know that Ontario is very well positioned.
Yeah, I know. In speaking to Premier Ford a few months ago, he mentioned that a lot of foreign business coming to Ontario, and that's obviously a big thing for your government trying to bring business to Ontario. How has that been going over the last few years?
You know what attracts businesses, whether they're here and they want to reinvest capital or they want to come from abroad and reinvest capital, is setting up the conditions that they can compete, which is good because they can innovate and thrive. What that means is, you can't do permitting that takes you 5 years to a maybe, cutting regulation, unnecessary red tape that's outdated. They cost inputs, be it energy cost inputs or technology, investing in technology, putting the conditions for more research and development. We have great talent, but making sure the education system has the tools to supply the type of labor, be it technology, be it advanced manufacturing, be it skilled trades, be it health services. That is a competitive advantage. And when companies look at that, they're more certain about getting a return on their investment. So we look at it as what are the things we can do to set the conditions for economic growth. And maybe if I can touch on, why does Volkswagen want to create 3,000 jobs here and another 27,000 indirect jobs in St. Thomas? Well, they look at all those things and say, this is good people, good markets. We've got land, we've got labor, we've got critical access to critical minerals. We've got one of the cleanest energy grids, not just in North America, but in the world. So for ESG, that's important. So Ontario has all the key ingredients, and that's what drives capital to invest in this great province.
Yeah, I know it sounds fantastic. So I get around a lot, I speak to a lot of small businesses, individuals. Speaking to Dan Kelly, head of CFIB recently, he was on the show a few weeks ago, and everyone's kind of saying the same thing, that they're struggling at this point in time, struggling with higher costs, higher interest rates, inflation still being elevated. What is your government or the Ontario government doing to help these businesses, these individuals cope with obviously an environment where we're seeing a lot of rising costs, whether it's, as I said, from interest rates or from inflation?
Yeah, that's a very fair question. And I think a number of things. If you go back to COVID, which no one likes to do, but I would say we supported many of those businesses that the CFIB represent through bridging, grants, not loans, but grants that they were able to take. We helped, for example, the restaurants and bars. We reduced the margin on the alcohol that they get from the LCBO. That put something like $100 million a year in their pockets. We allowed for delivery and takeout of alcohol and other things. So we did, those are more micro targeted to some of their members, but broadly speaking as well, I get back to the conditions, the WSIB premiums, being able to reduce those, less requirement for contributions there because it's fully funded. I think about the gas tax. We just announced again last week, we're extending the gas tax cut. That's 5.7 cents a liter, along with other things that we've done. That's 10 cents a liter that businesses and people would otherwise have to pay. And, it's not just the input cost to heat a small business, but it's also, the types of products they produce. If you get the energy costs down and provide some relief on a macro level, these are the types of things that we think about in helping small businesses.
Yeah, everything at this point in time seems to anything can help. I know that businesses are, for the most part, especially the smaller businesses, struggling at this point in time. I'm just curious, you hear a lot from the Bank of Canada these days. Do you speak to the Bank of Canada? And if you do, how often? I know that the Premier has sent a few letters to the Bank of Canada. I know other premiers have done that as well. Do you think any of these letters are making a difference? Do you think what we're saying to them is making a difference? I know obviously they like to be independent of any political affiliation at all. So, do you speak to the Bank of Canada? And if so, do you think you're having any effects?
Well, yes, I do speak to the Bank of Canada as a Minister of Finance, and I think my take on the Bank of Canada is they have a lot of inputs. They get data and evidence, but they do talk to a lot of people to get a sense of what's going on. And I think as a politician, yeah, they're independent, but I think also I'm sure people always want to hear what the condition on the ground is, and that's where Doug Ford and our government are very good, talking to people all the time where they're hurting, what's really impacting, and clearly these higher interest rates. The fastest rise, I think, in Bank of Canada history, 10 increases to 5% now. I think prime is over 7%. It's having its effect. We're feeling it on the ground. People who are refinancing their mortgages, people who are paying increased costs for food and for rent and other inputs. So people are feeling it at a time when there is all this uncertainty. So you'd have to ask the Bank of Canada. I did write the Minister of Finance about the Canada Pension Plan, and because I thought that that's very important that we talk about to provide stability where Alberta Pension Plan wants to leave the Canada Pension Plan. And, people work in Alberta and then they retire in many parts of the country and vice versa. So I think it's important that at this time we think about the hardships that people have, the uncertainties they have, and do everything we can to help them.
I know a lot of people knew that you're going to be on our show, and I guess one of the questions they wanted me to ask you was a question about taxes. A bit of a sore spot with a lot of Ontarians, I have to admit. I know some individuals, some of my former clients actually have left Ontario and they alluded to taxes as being one of the issues. I believe we're something like the fourth highest jurisdiction in terms of taxes in North America. Is there anything that I guess, provincial government can do to lessen the taxes paid by individuals in the province? As I said, I think you add the taxes paid, the higher interest costs, the inflation, slowing of business, it adds up. And so, is there anything we can do on that front from a tax perspective?
Well, first thing I would say, we already have done a lot of things, and we're a government that doesn't believe in taxing and increasing taxes on Canadians and Ontarians. First off, I mentioned the gas tax relief. I can also talk about small business tax, which we reduced. We put in a tax credit for manufacturing businesses to invest more in capital. A very bold tax credit that we announced last budget. We talked about the low individual and family tax credit for people making up to $50,000. With that tax rebate, 1.1 million workers in Ontario pay the lowest personal income tax in Canada. So that's helping the people that need most of the help. Now, in terms of people leaving because of taxes, we got 500,000 people that came to this province last year, and we got probably another 500,000 coming in this year. So we have a lot more people coming in that are leaving. And I would also say this: we can't provide more tax relief until we get our fiscal house in order. We inherited the largest sub-sovereign debt in the world. We're working very hard to provide fiscal responsibility at the same time as driving economic prosperity. We won't have a good standard of living or pass it on to the next generation if they have to increase taxes and cut spending because we couldn't get our fiscal house in order. I think it's also important that we have a good fiscal plan because you don't know what's around the corner. You want to make sure that you can handle whatever's around the corner. We talked about the potential economic slowdown. And thirdly, interest expense. The less we borrow, the less we have to pay in interest expense, and the less we have to pay bondholders versus Ontario citizens. And I'm pleased to tell you that our interest expense to revenue is the lowest since the 1980s. We've been able to keep our interest costs through less borrowing, doing more infrastructure borrowing, which is long term, and we've been terming out our debt over the last 5 years, 6 years with long-term debt 30-year bonds at the time when they were much lower. So we're spending the lesser amounts. It's still going up because interest rates have gone up. But let me just say, it's we're going to continue to be focused on providing money in people's pockets so they can reinvest in their business or they can reinvest in their families and households.
And obviously, yeah, borrowing 30-year when the interest rates were low, obviously a great strategy. I guess for my last question, you kind of gave a good segue into with respect to people coming to the province. And I guess you've been talking a lot about housing recently, housing affordability. And again, as the premier on the show was on our show a few months ago, he talked about flooding the market with as many houses, building as many houses as he could. And not sure where that stands at this point in time, but obviously housing is a big issue. You mentioned the amount of people that come to this province. A lot of them want to come to Southern Ontario. So housing is always an issue, housing affordability, another issue for individuals. Obviously an important part of the province, would you say?
Yeah, and it comes down to, without overcomplicating, supply and demand. We know the demand is there, but if we don't create more supply, all types of supply, then we know what's going to happen. So that's why, as part of the budget, for example, I had called on the federal government, and our government had over a year ago to cut the HST on rental buildings, purpose-built rental buildings. And I had it in my last budget that, hey, feds, we're ready to do it, but you need to do it. And they announced about a month ago. So we're now rebating the full 13% of HST for builders who build rental units. And I've been told that by many that this is a game changer. So that's just one example of how you deal with the housing situation. Number two, we announced in the fall economic statement the Ontario Infrastructure Bank. And one of the areas that I said our focus would be on, for example, is housing. And within housing, I'll give you an example, student housing. We have a great world-class education system in this province, but we have a lack of student housing. And so that's a natural for us to get built. Obviously, long-term care homes, another area where that's a form of housing for people that can't go anywhere else. They can't stay at home any longer. They need that sort of support. We need to have a building of more density. We need more affordable housing. We got to work with the federal government, the city of all cities right across the province to get that done. And I would just call, I didn't mention this, but I can't help myself, as we're cutting the gas tax, we're calling on the federal government, not just for housing, not only for infrastructure, but provide some relief to Ontarians with cutting the home heating part of the carbon tax. That's at this time, if you're ever going to do it, now is the time to do it.
And we hope that the federal government is listening to some of your ideas because they sound great. Mr. Bethlenfalvy, thank you so much for being on our show today. It's been a pleasure to speak with you and provide answers to a lot of the questions I've been receiving from individuals, small businesses. As I said, a pleasure as always.
Well, thank you, Allan. Look forward to getting back again with you at a future time.
Thank you. A great interview with the Ontario Finance Minister. Him provided us with his opinions on where he sees the Ontario economy. So thank you, Mr. Bethlenfalvy, Finance Minister, for coming on our show. Now we get to the part of the show where I talk about what I believe is important for individual investors to consider before you make your investment decisions over the next few weeks. We're going to speak about interest rates. Interest rates always seem to be one of the three categories on the list. And we're going to talk a bit about what goes into whether the interest rates rise or fall, some of the macro data, a lot of it we've been receiving out of the US macro data in the last few days, investors' returns, or in some cases, lack of returns over the last few years. We'll speak a bit about that. And dividends playing a big role in terms of how much growth investors will experience or have in their portfolios. We all know that dividend payers go a long way to in helping individual investors grow their portfolios. So we'll speak about those three things. So let's move to the first topic, which are interest rates. And I wanted to touch on interest rates because interest rates continue to drive the bus with respect to the stock market, right? Interest rates up and down, and as they move higher, as that 10-year US government bond rate moved closer to 5% and even peaked above 5% for a short period of time, stock market pulled back. And now we're seeing the opposite effect. We're seeing the 10-year pull back below 4.5% in the last few days, again in the US, and we're seeing stock markets surge. And wanted to touch on a few things that have come out that has caused interest rates, that have caused the 10-year to pull back. We're also seeing the 2-year government bond rate in the US. Those seem to be the two, the 10-year and the 2-year bonds seem to be the ones that most people focus on. And the first thing is job creation. And we have a chart here, monthly job creation in the US. You can see that it is definitely slowing. The last bar there shows October grew about 150,000 jobs. And if you look and kind of eyeball it here, you will notice that other than maybe June of this year, the October number was the lowest number that we have seen in the past few years. Obviously, a monthly number. So still growing jobs, but not as much as, I guess, other months. And again, it lends itself to that soft landing scenario or that Goldilocks scenario. Not too hot, not too cold, but perhaps just right. So jobs is something that the Fed will look at. Jobs, the stronger the jobs creation, perhaps the higher the interest rates move. Another measure, obviously, for interest rates, a key measure is CPI, or Consumer Price Index, which measures, well, basically inflation. And we have two measurements here. We always talk about them. We have the headline number and then the core inflation rate, which strips out volatile food and energy. And you'll notice here that the core rate has now gone down to just 4%. I say just because for the longest time it was, in the high fours, and it got to the low fours, and not many people were expecting the core rate to fall this past month, but it dropped from 4.1 to 4%. The headline number, which takes into account everything, actually fell from about 3.7% to down to 3.2. So we're getting pretty close to seeing a number on the headline inflation with a 2 in front of it. The market loved that when they got those numbers just yesterday. Markets rose in the US, and as we always say, Canada, Toronto stock market followed their US lead and moved higher. Markets are up 1.5%, 2%, depending on where you looked. They loved it. The markets love these numbers because it's telling us that we're still seeing growth in the US and maybe a little bit of growth in Canada, but we're still at the same time bringing down inflation. We also got a PPI number today. PPI is Producer Price Index, so kind of wholesale numbers, and that dropped as well. Retail sales, the chart on retail sales out of the US, and you can see here on the far right, you'll see retail sales number actually going negative. And we were expecting negative 0.1. We were expecting a negative 0.3. We got 0.1 negative on retail sales. And again, one of the lowest or one of the weaker retail sales numbers we've seen in a long time. And once again, maybe not good for the economy, but pretty good if you're the Federal Reserve and even, I guess, the Bank of Canada, because the hope is that we follow our US neighbors to the south, and we start to see our numbers start to pull back a little bit as well. But again, not pull back too much, because we don't want to hear about this talk about recession, mild recession. So we want a slowdown, but not a complete, washout of growth. We still want to have some growth in the economy. So we want to keep an eye on interest rates, and especially all the macro data that go into interest rates into the number. And lastly, I think we have a chart just on the 10-year itself. And you can see with all the data I just pulled up and a slowing down of all that data, it's no wonder that we're seeing the 10-year bond move back from a peak at the end of 2021. We saw it, kind of spike up again shortly thereafter, but it's been on a downward trajectory A bit of ups and downs here and there, but overall down to under 4.5% today. Second topic I want individual investors to focus on is this whole idea of investors' returns. And I want to touch on this for two main reasons. Number one, I want to touch on investors' returns because I've been getting a lot of, well, maybe not a lot, but a few questions about investors' returns. Why investors have not seen a lot in the way of returns over the last few years. And I guess when you look at or consider things, it shouldn't be a surprise, right? 2020, we had COVID, we had the pandemic. And really, it wasn't until the back half of the year that the stock market started to move higher in anticipation of better days ahead. 2021 was a fantastic year. 2022, the fourth worst year, as I've said on the show many times, for the S&P 500 since they've been keeping track. So all the positivity coming out of the pandemic and in 2021 was washed away in 2022. S&P was down over 20%. And this year, coming into this year, we really didn't know what to expect in the middle of a hiking interest rate cycle. The central banks around the world raising interest rates as aggressive as they have been doing. We didn't know what to expect. And it turns out, yeah, the markets have been doing well. However, if you factor out technology, or as we call it, the Magnificent Seven, or the biggest 7 tech names that are out there today, 7 largest companies, you probably aren't seeing much growth at all in 2023 either. So it's no wonder that if you take a look at a rate of return over the past few years, you're probably flatlining, or maybe you're squeezing out a few percent gains. Definitely not what many of us have been used to over the past decade. And we have a few charts that will illustrate what I've just said. First one is the S&P 500 index. You can see here that if you held the S&P, tremendous run in 2021, a pullback in 22, and you can see a bit of a surge in 2023 based on technology, as technology makes up about 30-40% of the index, but still not back to the highs of 2021. So if you're an index investor, which is my second point, someone who invests in an index, an ETF that buys the index, or an index mutual fund, you probably haven't made any money at all. But if you bought certain parts of the index, which we'll show you a couple of charts on in a moment, you actually can still make money even though the overall index has not done well. And wanted to take a next chart here, the TSX. Here's the TSX, and this chart even shows kind of a stagnant market or an index. You can see here that, again, reached a high in 2021, but really over the last couple of years, hasn't moved much at all. And we don't have much technology on our exchange. A few tech names like Shopify, etc., but definitely not as much or as many technology names as we see in the US. And that's why TSX this year is flatlining again, like the Dow Jones at best. And so back to this idea of picking winners and losers, not buying an index. If you were to pick the winners and losers over the past few years, you can still make some money in difficult markets. And one chart I wanted to show on that was the NASDAQ. And as I've said already, if you own the NASDAQ, and I show the NASDAQ because that is made up of primarily technology stocks, you've done extremely well in 2023. You're going from the bottom left to the top right. There have been some ups and downs along the way, some peaks and valleys, but pretty much had a fantastic year. For those of you that have had technology as part of a diversified portfolio, you've done well in that part of the portfolio. Last year, as I said, not as good as this year, and one of the worst years we've seen since World War II, but had you owned oil investments, you actually fared decently, not as bad as the overall index. And so we have a chart on light crude oil. We can pull it up here. It's a chart. There it is. And you can see in 2022, we had a spike initially in the first half of the year. Prices came down, but then another upward momentum. And if you take where the year started and where the year ended, you did okay in oil stocks. A lot of them that pay dividends. I always recommend oil stocks that pay dividends. You want to earn something while you hold out or wait for all this volatility to work itself out. So once again, owning index funds or an ETF that buys the index probably haven't fared too well in the last few years. But if you own certain parts of the market, oil last year, tech this year, I think you would have fared quite well. So something to consider before you make your investment choices. Lastly, or our third point, is dividends. And we talk about dividends a lot on this show. Everybody talks about owning dividend paying investments, opportunity to make something while you wait for the growth. And we have a chart here. I think it's the first time we've shown this chart. And it talks about dividend payers, nice colorful chart here. And you'll notice here that second quintile stocks outperformed most often from 1930 to 2022. So what does that mean? Well, what we did, or what they did in this chart, Hartford Funds, is they broke out dividend payers into 5 equal amounts. So 20%. So the top 20% dividend payers, the second 20%, the third, the fourth, and the fifth. And what we found out was it's not so easy just to go out and pick the stocks that are paying the highest dividends, because you'll outperform the market 67% of the time. It's not bad, but nowhere near as good as outperforming the stock market 78% of the time, or almost 80% of the time. And those are your second quintile. So going after the top dividend payers, you can try that. A lot of them may cut their dividends when times get difficult. A lot of those stocks tend to be a little more volatile. You got to really ask yourself, do they have the cash flow to pay these high dividends? Or do you want to own the second quintile, the second grouping of dividend payers that are in that, let's say today, 4 to 7% range? These dividend payers tend to increase dividends over time. They tend to be less likely to have to decrease their dividend payments. I looked at Canadian bank stocks, great example of names that would fit in that range. And the last thing I want to point out on this chart is the third quintile actually performs as good as the first. So I don't think you're really getting any further ahead by chasing the highest dividend payers. I think you want to buy good quality companies that pay good quality dividends, that are sustainable and that are growing over time. And to me, that makes the most sense. I have 2 charts here that I want to highlight, 2 stocks that I've talked about many times on the show. First one is Bank of Nova Scotia. As I mentioned, Canadian bank stocks are really good, fall into that second quintile area, I believe, with Bank of Nova Scotia. When you're looking for growth and income, you're looking at a stock that is down significantly from their 52-week and all-time highs, and will pay you a nice, healthy 7% dividend while you wait for the growth. And lastly, Enbridge, a favorite company, a darling company of all of ours. We all pay our Enbridge bills, unfortunately. Enbridge is paying close to an 8% dividend today. So you're actually bordering on that second quintile to first quintile area. But I think that dividend is secure. And Enbridge has made a number of acquisitions recently, and their cash flow, I believe, is great, and their dividend is sustainable. So overall, these are the 3 things that I want everybody to look at and consider before you make your investment decisions over the next couple of weeks. The markets are volatile. The markets will continue to be volatile. But I think if you focus on where interest rates are, that is the number one thing to look at. And then you want to consider, what you're investing in, what your returns are looking like, what your options are. And lastly, to give a bit of a boost to that return, you want to look at dividend paying investments. So the Fed has, in my opinion, added a lot to the volatility that we're seeing in the markets. And as I said off the top of the show, Mohamed El-Erian, Allianz chief economic advisor and president, Queen's College, Cambridge, was talking a bit about this in an interview in the past week. He says that a lot of the Fed governors are contributing to the volatility that we're seeing with respect to interest rates predominantly. And then, of course, the stock market takes its cues from the bond market. So the stock market volatility as well. And I think he pointed out 2 things. Number one, once upon a time, we heard from the Fed chair, whether it was Alan Greenspan, Ben Bernanke, but we didn't hear as often as we're hearing from Jerome Powell these days. We're hearing on a regular basis from Fed governors. Some are hawkish, some are dovish, some want to see more interest rate increases, some want to see less or hold on. And it's just confusing investors. And this week alone, I think we're going to hear from anywhere between 8 and 10 different Fed governors talking or speaking about their opinions, and it just causes a lot of volatility. The other thing that Mohamed Al-Arian pointed out, and again I agree with, is this idea that the Fed is kind of reacting or speaking about a lot of the economic data in the rear view mirror, not kind of giving us a proactive way of looking at what's coming down the road, but more reactive to the data of to the data that we've seen over the past month or quarter. And I know the Fed has said that they're data dependent, so I guess we should expect them to be more reactionary versus proactive. But in my opinion, I think you want a Fed that is going to look ahead to a day where maybe we see 2.5%, 3% inflation. Is that good enough? The Fed will probably tell you no, on the cameras, in front of the cameras, but maybe behind closed doors, seeing an inflation rate of 2.5%, I think is manageable for the Federal Reserve and even for the Bank of Canada. So for me, this volatility that we've seen, bond market, the bond market, biggest market in the world, 10-year treasuries, 30-year treasuries, 2-year treasuries, sometimes they're behaving like penny stocks. We're seeing them move significantly in just a few hours or even minutes, depending on commentary out of Jerome Powell or the Fed. So I just think volatility has been ramped up, and a lot of it has to do with the Fed. And in some ways, even though we all want him to be more and more transparent, in some ways, I think I'd rather have him say less, be a little less transparent, give a speech every now and again, let the Fed governors speak every now and again, but not as often. And I wanted to end this segment off showing a chart of the VIX volatility index. And you can see here on the far right how much it's dropped off. VIX trading under 20 usually shows a calm market. And right now it's about 14, 15. So yes, the volatility index is not showing us that there's a lot of volatility out there, but you can see how many times the VIX has spiked and come back down, spiked and come back down. And the chart here, unfortunately, doesn't catch all the intraday moves or day-to-day moves. This is a one-year chart. I guess if we looked at a chart over a period of a few weeks in and around a Fed announcement, you really would see the ups and downs of the bond market, interest rates, and volatility. So hopefully the Fed going forward can maybe be a little less transparent in some ways so that we could see a little less volatility and make investors feel a little more confident in investing going forward. So U.S. debt, as I mentioned off top of the show, I think this is my most powerful graph or chart. I think it's a graph that I'm going to show you. The U.S. now has well over 30 trillion in debt. And over the next, I guess, few quarters, they're going to be paying more in interest on that debt than they're actually spending on defense spending, which is pretty scary. And you can see that, or Bloomberg reported recently, that the actual amount has actually doubled over the past 19 months. Not 19 years, I was going to say years, but 19 months, which is pretty scary, right? In the less than 2 years, we've seen this amount double. And so let's show the chart of the cost of U.S. debt piles surging. Look at that graph. Wow, it's unbelievable how steep that line has become. And you can see in the last couple of years how high the cost of U.S. debt has become. And really for the markets, I think what it comes down to is, when the bonds, when the Treasury Secretary has to, I guess, pay for all this debt, when the U.S. has to pay for their debt commitments, they have to pay for, things such as the CHIPS Act or the infrastructure bill that they're putting through. So they have to raise the money. They have to sell bonds. And of course, they have to pay interest for all the bonds that they're selling to raise all this cash. And lately, some of the bonds they've been selling, especially some of the longer term bonds like the 30-year, those auctions aren't going so well. We're seeing interest rates rise significantly on the days of those auctions because nobody seems to want to hold long-term debt in the US at 4%. They won't even consider it unless you're offering it at 5% or higher. So we're seeing the long-term bonds really affected by the amount of debt that the US is carrying. We're hearing more and more politicians, we're hearing analysts, economists really speak a lot about US debt and the amount of interest this is going to be costing the country in the coming months and years. And the hope is that they can get their spend under control. We've been saying that for a long time, but hopefully, whether it's Democrats being reelected next year or whether it's someone else that comes into the White House, hopefully they can attack this debt level and really bring some comfort to a lot of investors. Now we come to the show where I wanted to talk about 3 reasons that I think the stock market can move higher, will move higher in the last quarter of the year. And I know we're kind of a third of the way through. We're maybe half of the way through now, middle of November. But I wanted to talk about why I'm expecting a rally, I guess, last half of November and into December. And 3 reasons in particular. The first one is interest rates. And I think interest rates have calmed down. We spoke a lot about what goes into interest rate movements, what causes interest rates to move, and I showed charts on it. And I have another chart here on the U.S. 10-year Treasury, a bit of a longer look at it, 6-month versus 3-month. You can see it there. You can see interest rates have really begun to stabilize, and I think that is because many people believe that the economic or the macro data has gone from being red hot to slightly lukewarm. Not cool, but lukewarm. And I think Fed officials will like that. I think that's as interest rates stabilize, and if they do not raise interest rates any further, they meaning the central banks, I think that's the first and number one catalyst for this market to rally around to take this market higher. Second reason, and I mentioned this on our previous show, is seasonality. And a beautiful chart that we have here looking at seasonal the months, seasonality here, S&P index averaging percent change each month. There it is. And you'll notice that the one disappointment I've had, I guess, recently is the month of October. Normally, October goes from come in on a negative tone and exit on a bit of a positive tone. We didn't see that this October. And it seems like the rally in the markets didn't really pick up until the first week of November. But you can clearly see here that November, December, January, 3 months in a row where where you see good gains in the market. So I think seasonal factors will help this market as well. And lastly, I think the market is cheap, relatively speaking. And you're going to be thinking, Allan, cheap? Market is trading at 18 times earnings. The S&P is trading at 18 times earnings. Historically, that's not cheap. Well, in my opinion, if you strip out technology, which is probably the most expensive or one of the more expensive parts of the market, the rest of the market actually is very cheap. Bank stocks are cheap. Pharma, some pharma, I shouldn't say all pharma, but some pharma is cheap. Retail is cheap. Even oil stocks are trading very cheaply. So there are a lot of places to go in this market if you factor out technology. So when somebody says market's too expensive, it's not going anywhere, that's not true. Factoring out the Magnificent Seven, the biggest 7 tech stocks, and you can find a lot of cheap investment ideas and even some ideas in the tech space. And one of the last charts we have for today's show is industries with the highest PE ratio. And you can see some of them here. They're broken down a little differently than I break them down, but you'll see software applications. So there's your tech, software infrastructure, again, some tech. So you can see some of the columns here or some of the bars that show some of the highest PEs. But overall, make no mistake about it, there are a lot of inexpensive ideas to be investing in today. And that's why I've been so bullish for the last little while. Coming into August and September, I felt as though market, could have a bit of a pullback because we were coming in on such a high. September, October, such a low. Coming into November, December, and I think even January, coming in on a low. And I think we're going to really change that. And I think these markets will go higher. I'm hopeful we will see some sort of Santa Claus rally. And I think markets will end the year on a positive note. So best part of the show for me is when I get to answer some of your questions, and keep those questions coming in. I love to receive them, and always like to understand what people are thinking, what kind of questions they may have. And I actually have to put on my glasses for these ones. First question here that actually a couple of questions I could probably answer fairly quickly. In your investments, do you have a specialty, or maybe we say as an investment advisor, do you specialize in any specific sectors or area? I said I can answer that one quickly because I really don't have a specialty. My specialty is building portfolios to meet the needs of individual investors, and I build those portfolios from scratch each and every day. And over time, I monitor those portfolios for possible changes. And if any of you watching today listen to the Sunday Money Show when I'm on every other Sunday, we talk about that, and we mention that as the Allan small difference. Second question, how many clients do you have, and are you still taking new clients? To be honest, I don't know how many clients I have. I would say a fair bit. Am I taking new clients? Yes. Always looking to help as many people as I can. Let's try and take one more quick one here. Given the state of the world right now, are there certain sectors I should be concentrating in with my investments for 2024? Tough question to answer because I'm more of a bottom-up stock picker than a top-down. So to me, I would say I would look for investment ideas that are cheap, that are good quality, and if you can get a dividend while you wait for the growth, if that investment pays a good dividend, that's where you want to be. I don't think it matters the sector you're in. I think you want to own some amount of technology because I think technology is probably the most dominant sector of the market. So owning some big cap tech makes sense if you're looking for growth, but I think you could diversify right across the spectrum. I think interest rates are done moving higher. And with that in mind, I think you can go into banking and other areas that seem to be a little bit sensitive to higher interest rates. So with that, I want to say thank you so much for joining me again today. Thank you for taking the time out of your busy day. Thank you for watching. I look forward to seeing you all on our next show. Catch our next episode on Wednesday, November 29th at 12 noon. And until then, happy investing.